The man, the myth, the legend, Warren Buffett said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So that's exactly what I've done with Texas Instruments, ticker TXN. I just added more as of this recording. And hey, what's up? I am Russ. This is my channel, Dapper Dividends, where we talk about making money through dividend growth investing. And yeah, check it out. Everybody, including my daughter, who's a freshman in high school, is using the Texas Instruments, their famous graphing calculator, where it is still being sold en masse here at ticker TGT, Target. Look at that thing, the TI-84 Plus graphing calculator going for $118.45. And I think it's a really cool company because not only are they a calculator company, they're so much more than that. But one of the things they're also getting into, as you see here, is the EV space with the vehicle to grid, unleashing the power of EVs. So what is this V2G, the vehicle to grid? Bidirectional charging. So basically what this will do, as they envision fleets of EVs providing battery power to reinforce electric grids, particularly during peak demand. And the link for this post is below. You can read it for yourself, but you can see in this nice little depiction here, they're showing that what your EV can possibly do is power your house and even kick power back to the grid to help us all out. So I think it's really cool, really forward looking. As Henrik Mannison, the general manager for grid infrastructure, said, the problem is not the overall capacity of the grid, it is the peak capacity of the grid that is the challenge. We all know these peaks are getting higher and coming more often as we grow more reliant on power. Extreme weather events add more strain on the grid. With semiconductor technology, V2G bidirectional charging could smooth out these peaks, which would benefit us all. So, Texas Instruments is a really diverse company, and they are the leading supplier of analog devices, which is just one more feather in the cap of this great company that is even year to date. Check it out. The S&P 500 has a return of negative 23%, while Texas Instruments' total return, mind you, is negative 13%. So doing better than the S&P 500. And going back to Buffett, I think that Texas Instruments is a wonderful company. Simply Safe Dividends gives them a safety score of 90, which is very safe. They're a mega cap company with a $147 billion market cap. Now, they do have 18 years of growing dividends, but they have a 60-year uninterrupted dividend growth streak, making them a dividend king. Their last increase was just announced September of 2022, 7.8%. But look at that 20-year CAGR, 22%. That is really fast how quickly they're growing the dividend. But we'll see in a minute that it's pushing their free cash flow payout ratio up a little bit high. So I'd like to see that start to taper off. I'm gonna be curious to see what management does. Currently paying $4.96 per share. $1.24 per quarter is what they're paying, and they do pay every February, May, August, and November. And don't forget their next ex-dividend date, depending on when you're watching this, is 1 month away on October 28th. And the dividend yield, check it out, 19% above their 5-year average for old Texas Instruments, which is really nice to see. Their PE ratio is 17.9, which is below 22.1, but I want to show you something. I think something that's a little bit more useful is the enterprise value to Ebitda. So you have the enterprise value, which is the whole shebang for the company. That takes into account the market cap plus all their debt. So if you wanted to buy this company, you obviously would have to include the debt. So the enterprise value to the earnings before interest, taxes, depreciation, and amortization is 13.15 times. That's the multiple. And we see that it is currently at 13.27, which they lied here at 13.15, but okay, we'll go with it at 13.27 is the current, and the 10-year average is 12.73. So it's just a little bit above average, which means, in my opinion, this is a fair price for Texas Instruments. And if we look at Morningstar, as of July 27th, 2022, they give them a 3-star rating with a fair value estimate of $166. So currently 160.84. It's, again, according to Morningstar, right in that ballpark, and they do have them as a wide economic moat, which is something we'd love to see as dividend growth investors. And their 52-week price range, currently obviously toward the low end, as a lot of stocks are, and they are more of a techie company, which those have all been getting slammed as of late. So that free cash flow payout ratio is at 70%, and we see ever since 2018, it has been coming and creeping up just a little bit. So we'd like to see that going down just a hair. And we see their free cash flow per share is pretty much stable, $6.38 per share. Sales growth has been dropping down just a little bit. They were at 27% growth in 2021, which was nice. Shares outstanding, again, we'd love to see that down to 934 million shares. They are consistently buying back shares. And their total sales are up to $19.6 billion per year, which is really, really stout. A couple more metrics. Return on invested capital at 48%. So basically what that means is right now for every $1 we invest, we can expect to receive about 48 cents. Free cash flow margin has been dipping a little bit, 22%. So for every $1 that comes in the door in sales, as I understand it, they're keeping about 22 cents, which obviously, as you can see, Simply Safe looks for above 5% for semiconductor firms. So TXN knocking that out of the park. Operating margin really stout at 53%. And now they show net debt to capital at 0, and I'm going to show you why I think that is. It's because when we look at their long-term debt for the quarter ending June 30th, 2022, it was $6.75 billion, which is a 17% increase year over year. But for that same quarter ending June 30th, 2022, they have $8.39 billion of cash on hand, which was an increase of 13.49%. So they clearly have enough cash on hand to pay off all of their long-term debt if they so chose to right now, which we absolutely love to see, a balance sheet that very nice and strong. And their interest coverage ratio, you guys know me, this is one of my favorite multiples to look at. This tells us how much operating income they have to cover their interest expense, where we see currently that Texas Instruments has $52.75 of operating income to cover every $1 of interest expense, so they can easily cover the interest on their debt. So they are in no danger right now of being affected by the rising interest rates. So this is pretty much a new position for me, owning Texas Instruments outright, and I believe it is at a fair value, but sometimes I'm willing to pay up for the quality companies, and a fair value for a quality company, I think, as Buffett would agree, is a really good bargain right now, especially in this market. So I'd love to know, share with us in the comments below with all of us around here what you think of Texas Instruments. Are you buying them? Do you own them? And speaking of people that are buying things, hey, I just did a video right here on Mr. Ray Dalio and the top 10 dividend stocks that they increased their position size, and one of them was over 10,700%. So click on this video in my little head to find out which one that was, and I will talk to you there.